Hello, good afternoon, everybody. It's November 14th, 2:45 p.m., Monday, and we're looking at a one-year chart of XLE. This is the Spider Energy Select Index ETF. And right here, we've got, of course, the price action at the top. Right under that, we've got volume, and then under that, we've got historic implied volatility. So you can see historic levels in the 52-week range. We're talking about around 15% as our historic implied volatility. Currently, we are at 41%, so slightly over 2 times historic implied volatility levels. So still a nice amount of excessive implied volatility priced into XLE. So a couple things here. First, we've seen a really swift move from this 55 V bottom all the way back up towards this 73 price point, 72.50 to 73 range. We are bucking up against this 200-day exponential moving average, or simple moving average rather, and you can see we've seen quite a bit of resistance at this level. So we're back towards the top of this range here, and we just see an opportunity on the bearish side of things. So on top of the 200-day moving average, we've got previous support turned resistance right at that 72.50 level. You can see several areas back here where we had some support interest, and since it broke really strong there, this is now a valid support turn resistance level. Couple that with proven resistance here recently and the 200-day exponential moving average, we've got a pretty nice scenario going on. So we want to put in a bearish position here. 72.50 is the main resistance level, but we do want to give it a little bit of breathing room. So we're going to go with a more conservative vertical spread here. Before we switch over to the options, just wanted to point out one other thing. If you look at the light sweet crude futures, what you can see here is crude futures are right around 100, and there's a lot of resistance here at 100, and it's a big psychological barrier. We printed 100 earlier today, and it pulled back, or just under 100 earlier today, and it's pulled back pretty swiftly, now down about 1% in crude. So this is a good complement to the trade. If we see downside pressure in crude, then that's going to correlate with downside pressure in XLE. So that's just kind of a icing on the cake type of thing. So based on our bearish thesis here, conservatively bearish thesis, we are looking at the 74.75 bear call spread. So first we pulled up XLE here, and if we drop down here to verticals and then expand December's, then we look for the 74.75. Here it is right here. Click on the bid, and it's going to pull up here, 36-cent credit. Our mid is 36, the nat is 33, roughly. So we got about 2-3 cent mid to nat spread. But this is very liquid. XLE is plenty liquid. There's nothing to worry about here. Let's right-click on the trade and analyze duplicate trade. So here we're just analyzing it based on a one spread to keep things simple. And of course, you can do as many spreads as you want based on what your capital risk you're willing to take. So let's switch our probability date over here to December 2011. So we're going to December 17th. And then I'm going to hit set slices to break even on December 17th. You can see our break even is 74.36. We're actually going to put this in at a 35-cent limit. So our break even will be 74.35. And you can see 66% probability of success, 33% probability of break-even or worse. So very good probability of success on this particular trade. We're being fairly conservative. A lot of positive theta taking place here. And of course on the x-axis we've got the price of the underlying, which in this case is XLE. And on the y-axis we have our profit loss. So the zero line is break-even. Anything above that is profit. Anything below that's a loss. You can see per share we've got we're profitable at or above 74.35 roughly, which is our break even, and max out our profits of $35 per spread at or below 74. So then when we go back towards this way, you can see our profits diminish as XLE starts moving above 74. Then we hit the break even at 74.35. As we move above 74.35, we start to be in losing territory until our losses are capped out there or bottomed out at or above 75. $65, so we're basically risking 65 to make 35, which doesn't sound that attractive from a risk-reward perspective, but you got to factor in the much higher probability of success than if we were doing a 50-50 situation, or even taking on a little bit more aggressive stance where we had a 40% probability of success, 60% probability of loss, but we were obviously potentially risking less to make more. So in this case, risking 65 to make 35 with a 67% probability of success, giving us a nice cushion here with 74.35 break even on XLE. Take that over to the chart here. Let's bring out the oval tool. 74.35 is our break even. We got December expiration, and it's going to be right over in this general vicinity. So you can see that gives us plenty of room above this 72.50 resistance level. And in the event we do see a break and hold above this 72.50 resistance area, we will just exit the trade for a loss. In the event we see a quick, swift downside move, maybe towards the 67.50 price point, we'll go ahead and take profits. Rarely do we hold these spreads into expiration. Typically, we're exiting around 2 weeks prior to expiration, sometimes a week prior, or sometimes several weeks prior, depending on how quick a swift of a downside move may or may not happen. So here we've got high implied volatility compared to historical implied volatility. We've got nice bearish thesis here with this strong support turn resistance level coupled with the 200-day exponential or simple moving average resistance and proven resistance here recently. And then we've got the crude oil testing at this 100 psychological barrier, likely to see some resistance at these points. So all in all, it's a trade that we like. Nice conservative trade. If you have any questions, feel free to send an email, nick@tickertank.com.